Welcome to the session on measures to control deficient demand and excess demand from the unit Determination of Income and Employment. I'm Tejinder Khosla and I've been teaching economics for more than 30 years. I was heading the economics department in a leading institution in Delhi NCR. In this session, I'll be discussing the fiscal policy and the monetary policy to control deficient demand and excess demand. In my earlier videos, we've already discussed the concepts of excess demand and deficient demand. In this session, we will understand how these economic fluctuations can be controlled. During the Great Depression, modern economists led by Keynes pushed for government and central banks to play a proactive role in the economy. Keynes gave a revolutionary turn to economic thought, which popularly came to be known as the Keynesian Revolution. He emphasized the role of government and central bank of a country to influence and control economic fluctuations like inflation and depression. Governments influence the economy by changing the level and types of taxes and the extent and composition of their spending, and this is known as the fiscal policy. On the other hand, central banks indirectly target economic activities by influencing the money supply through adjustments in the interest rates and bank reserve requirements, and this is called the monetary policy. Let's now define fiscal and monetary policies. So fiscal policy is the revenue and expenditure policy of the government in which taxation and government spending is used to influence the economy. Monetary policy is the policy of the central bank of a country to control credit and money supply through various instruments. There are two types of monetary policy measures. First, quantitative measures like bank rate and cash reserve ratio, etc., and qualitative measures like margin requirements and moral suasion. Quantitative measures control the quantity of credit and money supply in the economy, while qualitative measures control the direction of credit or money supply. Let's dive deep into understanding how fiscal and monetary policies control the situation of deficient demand and excess demand in an economy. Deficient demand is a situation where aggregate demand AD in the economy is very low. Therefore, fiscal and monetary policies both aim at increasing the level of AD in the economy. Fiscal policy has two components: government expenditure G and taxation TX. We know that AD is equal to C plus I plus G plus X minus M. Therefore, G and TX both will have an impact on the aggregate demand in the economy. During deficient demand, government increases its expenditure G, thereby increasing the level of AD directly. On the other hand, it decreases the level of taxes in the economy because decrease in taxes will increase the disposable income of the households, thereby increasing their consumption demand, leading to an increase in the level of AD in the economy. Monetary policy has various instruments through which deficient demand can be controlled. The first one is bank rate, which is the rate at which commercial banks borrow from the central bank. Cash reserve ratio CRR is the proportion of deposits which commercial banks have to keep with the central bank as reserves. Statutory liquidity ratio is the proportion of deposits which the central commercial banks have to keep with themselves as reserves. Repo rate is the rate at which the central banks lend money to the commercial banks for their short-term needs. Please remember that bank rate is for long-term requirements of commercial banks, and repo rate is for short-term requirements of the commercial banks. Reverse repo rate is the rate at which commercial banks park their funds with the central bank. And open market operations, OMO, refers to buying and selling of government securities by the central bank in the open market. So during the situation of deficient demand, bank rate is decreased because a decrease in bank rate will increase the money supply in the economy, leading to credit expansion, thereby leading to an increase in aggregate demand. A similar situation happens when CRR is decreased, SLR is decreased, repo rate is decreased, and reverse repo rate is also decreased. All these measures will increase money supply in the economy, thereby increasing the level of AD in the economy. In open market operations, the central bank will buy securities in the open market from the public, thereby increasing the money supply in the economy. This is called cheap money policy, whereby the money supply increases because it becomes easier and cheaper to borrow money. That leads to credit expansion in the economy. Now we come to the situation of excess demand. So during excess demand, the level of AD in the economy is very high, and therefore the main aim of fiscal and monetary policies is to decrease the level of AD in the economy. And for that, government will decrease its expenditure, G, and it will increase the level of taxes in the economy, both of which will have an impact of decreasing the level of aggregate demand in the economy. Under monetary policy, bank rate is increased, cash reserve ratio is increased, statutory liquidity ratio is increased, repo rate is increased, reverse repo rate is also increased, and under open market operations, the central bank will now sell government securities in the open market to the public. And this type of monetary policy is called dear money policy, where it becomes expensive to borrow money. Credit becomes expensive, and therefore it leads to a decrease in money supply, thereby decreasing the level of AD in the economy. And this brings us to the end of this session. Hope you found the session useful. If you have any doubts, please leave them in the comment section below. In case you found the video helpful, remember to press the like button and share it with your friends. Subscribe to the channel for more economics concepts and tutorials.